Welcome to this session. So my name is Elon. The paper that I would like to talk with you guys today is about cryptocurrency bubbles. So the title goes, "Does mining fuel bubbles? An experimental study on cryptocurrency markets." So this is a joint work with my colleagues at University of Heidelberg, Marco Lambrecht and Andy Sofianos. So let me start. So when I talk about cryptocurrencies, right? So um, the first thing come to people's mind is Bitcoin, right? Because it's the most well-known, most popular cryptocurrency out there. And it was invented by Satoshi Nakamoto in 2008. And it is the first decentralized cryptocurrency. Was invented as a response to the financial crisis of 2008. You know, when people lost trust to the banking system, when government, governments around the world are printing money, right, to bail out their banking system. So from the start, Bitcoin evangelists, they say, well, it will become a widely accepted currency, media of payment, right? So, but for that to happen, right? So for something to be used as a currency, the value has to be very stable. So that's one key requirements necessary for functioning currency. But as you know, this is not really the case, right? So Bitcoin prices went from a fraction of a cent in 2009 to almost $20,000 in 2017. And in 2017 alone, Bitcoin experienced 5 episodes of losses of more than 20%. So that's quite dramatic, volatility that you see in this market. And Robert Shiller said, Bitcoin's volatility damage its store of value credibility, and it's a major hurdle to its acceptance as a currency, right? And in practice, if you talk to an investor, right, so the reason why they hold Bitcoin is not really that they're gonna buy pizza with it. Rather, they view it as a speculative vehicle that they can get some capital gains out of it, right? So that's the situation at the moment. But to understand why this is the case, right? To understand this bubbly phenomena that we see not only in Bitcoin market, but also a lot of other related cryptocurrencies, we have to talk about the technology behind it, right? So that's the blockchain. So what is blockchain? Well, loosely speaking, right? So blockchain is just a chain of blocks, right? So the block contains basically you can view it as a ledger, and that contains all kinds of transactions in the past, right? So that will be all recorded in the ledger. So if I transfer some money to Andis, my co-author, right, then it will be recorded there, and this maybe transfer another one Bitcoin will be recorded also there, together with thousands of other people's transactions, and then you will form a block, and you connect these blocks, right? So then you form a publicly available blockchain that is transparent, accessible to anyone. Everyone can have a look at it, can download it, right? And can actually everyone have the right to to try to add more blocks to the existing blockchain, right? Then the question is, who will be allowed to add blocks to the blockchain, right? So that would be a question. Well, the solution Nakamoto proposed is that, well, for this we need a consensus mechanism, and the consensus mechanism that Bitcoin will use, and together with 90% of other cryptocurrency out there at the time, is that we're going to use something called proof of work, also known as mining to most people, right? So this is the mechanism will say, who will be able to add more information to the blockchain. So the proof of work requires validators or miners to compete in order to update the blockchain by solving a mathematical problem that depends solely on raw computational power. Okay, so you just need very powerful computer to quickly solve some questions. So what I mean by that, well, how it works is the following. So you take the information in the block and apply a SHA-256 hash function twice to get a so-called hash value. Okay, so basically, you take here whatever that you have in your block, right? So this is very loosely speaking today because of in light of time. So this is ahead of the block, ahead of a block. So you take the information there and you do twice SHA-256 and then function, and then you get a hash value, okay? And in the information, if you're not trying to forge any block, the only thing you can change is a random value out there. Okay, so it's over there. So the only thing you can change is this random value. Then you get a hash value. Look like this. It's a 256 digit value. Okay, and so how do you know if you successfully solve the puzzle? Well, if the first n digit of the hash value equal to 0, then this is considered a success. If you manage to find this, then you can add new information to the existing blockchain, and then you will receive some reward from the central system for the effort that you that you take to solve this puzzle. Okay, and if not, then you continue with another random value over here, right? So you change the number, and then everything will be changed here, until you get a valid solution. Okay, the solution, or I should say, a targeted solution. Okay, and then obviously this n would measure difficulties, right? Because if you need more digit of n to equal to 0, it's going to be more difficult to solve. Okay, so that's what I mean by there's really this question itself really sounds trivial. It's just you keep changing this random value until you find a solution. There's no quick way or algorithm that you can really implement to make yourself to make this question easier. It's just you just enumerate a number of random value until you find the solution. So because each digit can only take either 1 or 0, the chance that you get the question correct is 1 over 2 to the power of n. Okay, and today the difficulty level n is set to be 76, so the chance you get it is this. So roughly 0, right? So even if you take the most powerful GPU out there, it's gonna take you over 1,000 years to find a solution, right? So that's how it goes. Why do I mention this difficulty level? Well, because importantly, Nakamoto already specify in the Bitcoin protocol that the difficulty level n is fluctuating, okay? And it should be target 1 block per 10 minutes on average, okay? So depending on how many people are mining, if you have more people mining, so you have more computational power, then the difficulty would also increase, okay? So that means that the supply of Bitcoin will be very smooth in the short run by design, right? Because of this target. So we call it supply smoothing mechanism. All right, so this is what happened in short run. And in the long run, Nakamoto also said that, and this is a beauty of this Bitcoin design, is that the total supply will be fixed at 21 million units of Bitcoin. No more, no one coin more, no one coin less, right? So it's fixed at this this level. So how do you achieve that, given that you just keep mining and every time you success you get a reward? Well, the reward will be halved for every 4 years roughly, right? So every 4 years, so at the beginning maybe you get 50 Bitcoin once you found a solution. And 4 years later, you're going to get 25 and 12.5, and so on. So the reward is going to be halved for every 4 years, as shown here by this orange lines. So so these, short-term smoothing function and long-term limited supply is some of the key features about this asset that we want to capture in the lab. We're gonna see whether these would affect the magnitude of bubble. And next, relatedly, right, so as more people are mining, as I mentioned, the difficulty level would increase. And this chart reflects the difficulty level since 2009 to recently. You see that the difficulty level is really growing exponentially because the number of miners are also growing exponentially, right? So people are more and more people trying to mine the asset to get the reward because Bitcoin values a lot, right? So this creates arms race naturally, in computational power because everyone try to mine as quickly as possible to get the reward as early as you can, because as you know, if you get it later, then you get less and less reward, and the first guy who finds the solution will receive the reward. That's why people really competing with each other with dedicated device to mine Bitcoin. And as a result, the mining is, has become highly concentrated recently. You cannot just mine Bitcoin using your own computer, even if you have the most powerful PC. It's still not possible nowadays. You need dedicated device, actually hundreds and thousands of them, to mine Bitcoin. It's becoming very, very difficult. Even these Bitcoin farms have to come together to form a pool in order to boost computational power, right? So that's because of the how the proof of work, how it works behind it, it leads to this sort of concentration issue. And we want to see also in the lab, whether this centralized mining applies further upward pressures on price. So here are just these are the goals of this paper, right? So we want to see if costly mining magnesium fuse bubble, right? So this is the first thing, and second, whether concentration also kind of exacerbate the problem. So here now I come to the experimental design and procedure. So let me quickly get into the design. So our basic experimental setup is very close to Smith from Bowling and Welford 2000, or more well-known Smith 200 William 1988 paradigm. But instead of a decreasing fundamental value, we chose an environment that is not, that has a flat fundamental value or constant fundamental value. So this environment is known, not prone to bubble as compared to other environments. So the way we implement that is that we're gonna have a final redemption value of either 0, 15, 30, or 67 with equal chance, right? So this is the only source of value of the asset, right? So that's the fundamental value. Asset is just 1/4 of the sum, right? So on average, you're gonna get 28 experimental currency units. So there's no intermediate dividend payment. So in between, from there are 15 trading periods, and in between there are going to be no dividend payment, only the redemption value at the very end. The trading institution is continuous double auction, right? So as normal, and we implement this 2x2 design. We're going to vary whether there exists mining technology or not, right? So either this is how people can acquire the asset. Either you get the asset as a gift endowment, or you can mine the asset, right? So that's the one aspect that we vary. Another aspect that we're gonna vary is whether mining is highly concentrated or not. So whether all have access to mining facility or only half have access to the mining facility. So we have gifts all, so that means, gift endowment, and all can have access to, also a gift all means everyone have the asset from the beginning, and mining all means that everyone have only cash, and if you want to mine, if you want to have asset, you have to mine. Right. Similarly, if a mining half, that means only half people can mine. The other people, if they want to have assets, they can only buy on the market, just like in the real world nowadays. So how do we implement mining? So in every period, subject can spend their cash holding on asset generation. So they can invest some money to mine the asset. So this sort of captures the mining cost. So the expenditure allowed to spend on mining per period is capped. So this is to capture the short run sticky supply. So it's not like that. It's not like if you see the prices are pretty high at the moment, and you're gonna invest a lot of money in mining and then profit from it. It's not possible, because there's a certain upper limit that you can spend each period on mining. This is to capture the short run sticky supply feature that you see in real world, right? And the marginal cost of mining is rising, okay? And the mining cost depends on the cumulative number of coins that has already been mined so far. So you see this graph over here, right? So this graph, actually a participant also see a graph like this. So they know that if lots of people have already mined the asset, it's gonna become more and more costly to acquire the asset. So why this form? Well, the main goal of this is to mimic the reward halving that you see in real life, right?
Excuse me, can I ask a quick clarification question?
Yes.
Do you mine the currency or the asset?
Oh, sorry. I mine the asset. The asset is this asset would be the Bitcoin, basically. Well, we don't call it that way, but this asset is mimicking the Bitcoin.
Thank you.
So you sort of mining Bitcoin in our lab, but we don't call it that way. Yeah. Thank you, Yaru. So yeah, so I was saying, so because of this cost function, right, and because of the expenditure cap per period, the reward of mining will be reduced exponentially, right? So so this captures the long run limited supply, because you can only spend a certain amount of money, but then it gets more and more costly. Therefore, the yield become fewer, right? So if everybody mine at their full capacity allowed, then the mining cost would exceed the fundamental value of 28 ECUs after period 5. Okay, so roughly in the middle of the experimental market. So here is a comparison between the real world parameter and our experimental setup. So here the solid line is basically the Bitcoin supply in real world, and the yellow lines here are the rewards. And on the right hand side, you see this this purple curve being the supply of the asset in our experiment with mining, and here is the reward. So you see this roughly a decreasing reward and a concave function of supply reaching a limit. So so that's how we implement mining in our lab. Remember that another aspect that we want to capture in this experiment is concentration, right? So this is as a result of proof of work mechanism that people compete their mining their computer computational power, right? So this will lead to concentration. So we want to see whether concentration play a role or not, right? So the way we're going to do that is that we in one treatment everyone can mine in the mining treatment, and in the other treatment that we're going to assign them to assign trader to different types, either type A or type B. So in mining half treatment, so only half people can mine, right? So type A trader start with cash and can mine asset. And type B trader, just like normal investor, they can only buy, if they want to the asset, they can only buy on the market. So as a control treatment to the mining half, we have also this gift half treatment, where the trader A start with both cash and asset, right? So instead of mining the asset will be endowed to them. So so this will have this endowment asymmetry, and see whether, if we have an effect over there, whether that's due to endowment asymmetry or is it really due to mining. And type B again start with only cash. Okay, so these parameters are carefully calibrated over there, to make sure that the cash to asset ratio are comparable across treatment. Now, the procedures, or the total number of 286 subjects have participated, and we run at University of Heidelberg and Frankfurt. We have 9 sessions for each treatment, so a total number of 36 sessions in total. And on average, people earn €18 for a 90-minute experiment. So before I go to the result, is there any questions regarding design? How long do I have, Tibor? Sorry.
3 minutes.
Ooh, okay. All right. So here are the results, right? So the result won't take too long, right? So because you will see the graphs and everything will be clear, hopefully. So here's the price chart, right? So the solid line here is the fundamental value of the asset, and it's flat, right? It's quite boring. It's flat, and let's see what happens if we have this baseline give all treatment. So just like a standard asset market experiment with flat fundamental value. Previous experiments show that it's not going to bubble, and this is exactly what we find. So we find elevated price, which is not surprising, given our cash to asset ratio is about 10. So we have a little bit elevated price, but we don't see any pattern of bubble and crash. So let's see what happened when we introduce mining. So instead of endow them with money, endow them with asset, they have to mine the asset and see what happened. As you can see, the price chart looks like the following. So you see a steady increase in price before it peaks, 3 periods before it stops. Before market ends, and then it crashed, right? So exhibiting a clear bubble and crash pattern over here. So what happens, if we have this gift half treatment where we have this asymmetry endowment, but there's no mining, whether that's affect pricing? As you see from this dotted dashed green curve or price trajectory over there, price again follow fundamental value quite well. There's no pattern of bubble and crash. But once we introduce mining, if only half people can mine the asset, so this is what we find, right? So you see a huge bubble and crash happen in this treatment. So we also employed common bubble measures employed in this literature, and without bothering with details, these are highly significant if you compare these mining treatment with their respective baseline. But I do want to spend a minute to dig a little bit into the underlying channel behind it, right? So here on this price chart, I first plot you the realized mining cost. Okay, so this is a treatment where everyone can mine. All right, so all can mine. So this is a mining cost, the realized mining cost. The mining cost, remember, that depends on how much people spend on mining, and this is the price, right? As you can see, in every period, price seems to follow this mining trend with a bit of markup until it cannot sustain anymore and crash, right? So mining costs seem to serve as a support to market prices for this mining oil treatment. Okay, so when everyone can mine, And this column over there show you how much people spend on mining in each period, and this all makes sense, right? So at the beginning, mining is cheap, so people mine a lot, and then price is still above the mining cost, so people keep mining until towards the end, then fewer and fewer people still mine. And then the right dotted curve shows you the realized cost of mining for the mining half treatment. So that means that only half of the traders can mine, the other half can only buy on market, right? So this is the realized mining cost, and this is the price, right? So this is the price trajectory in this treatment. As you can see, there's no sort of following the trend and then crash. It seems that because of this asymmetry, or because of this mining concentration, the initial demand is so high that it pushed up the price and decoupled from the mining cost already early on in this treatment. And it seemed that bubble arrived earlier in mining half than in mining all. And this is we can confirm that by looking at the first half of the market and compare the bubble measure, and this is indeed the case. So bubbles seem to arrive earlier in mining half treatment. All right, so I'm gonna skip the individual measurement because I didn't have much time to talk them anyway. So, but they are in the paper. So conclusions. So in the absence, so what we find, so in the absence of mining, we don't find any sign of bubble and crash. Okay, so without mining intervention, there's no signs of bubble and crash. And endowment asymmetry, despite there's literature, showing that it may have some effect, but in this environment that is not bubble prone, we don't see any bubble happening just because of endowment asymmetry. This itself is not sufficient to generate bubble. But when mining or proof of work mechanism is introduced, right? So then the bubble and crashes are frequently observed. When everyone can mine, prices follow mining costs closely before it crash. And when only half of the people can mine, price even surge significantly earlier, and prices are decoupled from the mining cost. So we provide a first piece of evidence in a control lab setting that shows the proof of work mechanism may be responsible for bubbles observed in cryptocurrency market widely, because this is really sort of the key difference from this type of asset versus other financial asset. So this is kind of a new mechanism embedded in in this sort of asset. So the mining concentration, right? So this issue implied by the proof of work mechanism, as we show, may exacerbate the problem, and you see even bigger bubble over there, right? So making this phenomena more dramatic. So our result lends support to ongoing search for better consensus mechanism, right? In finance literature, right? That is, that won't, for example, lead to concentration and won't, people won't compete against each other, right? So for computational power, and also that there are other consensus mechanisms people look into that do not have this feature of short-term supply. Remember, the difficulty level was targeted such that in short run, the supply is very much smooth. So when there's demand shock, you cannot keep up. And we show that in a control setting, this indeed would exacerbate bubble. So thank you very much. I'm happy to answer any question that you might have.
Thank you very much, Yilong. This was a very interesting talk. So maybe we have time for one question if there is one. Otherwise, it's also good to
Can I? Hi, everybody. Can I ask a question?
Yeah, sure. Yeah.
Okay. So Actually, I think if we're looking at all your treatments, only the last one, the half mining, is I mean, as far as I can understand, this is the simulation of the field, right?
Yes.
Because
yes.
in this case, only in this case, if you see the red line, you have a bubble, and the reason is that you have people who buy the asset but don't mine it, right? So my question is, what information do they have as far as mining costs? And if they don't have any, if they don't have information about that, then obviously you'll have a bubble, because people trade based on no information, right?
No, they do have the information. They know they see this. They see a graph of bubble mining costs, and they have a calculator each period to figure out how costly it is to mine. So people do know, the mining cost, the trend of mining cost is increasing and will going up, and depends on how many people participate in mining, how many asset has been mined so far. So they do have some information on that.
So when all of them mine, prices pretty much track fundamentals, although you can see a bubble, but I guess the bubble mitigates the cost of mining, so it adds to the value. But when they have the information but they don't mine themselves, this is where you see the bubble. I think this is where this is the most interesting part. Okay, thank you anyway. It's really interesting.
Thank you. Yeah.
Yeah, thank you, Yilong. I also have a question or two, but I'm going to ask them at a later point in time, because we have to move on. Yeah, so thank you very much. The next talk on our list is Vladislav Mil from the University of Vienna. Please go ahead, Vladislav.
Hi everybody. Thanks for coming. Actually, I'm in Mannheim now, but all right. Quick warning, I have apparently very bad internet, so it might happen that I will disappear. I will come back, ideally, in such a case. And if not, we will have soon a working paper, and then you can read that stuff. So this paper is together with Fabian Brunner and Fabian Gamm, who are at the University of Mannheim. And the title is My Portfolio, the IKEA Effect in Financial Investment Decisions. So I think you know that much better than I do, but in order to benefit from diversification, investors should hold a portfolio of financial assets. And one can either build such a portfolio oneself, or one can just buy a predefined fixed portfolio by a manager. Now, nowadays, retail investors can basically self-build such a portfolio much easier because of ETFs. So for example, if you look at BlackRock, you can basically design and adjust shares of certain stocks and funds such that you have your own portfolio. Or you can basically, as an alternative, buy a fixed portfolio from a manager. And typically those two do not differ that much, because the options you have here are not too broad. So typically you end up with something very similar to what is already fixed as a predefined portfolio. Now, if you look into the literature on IKEA effect, which is this paper about, what has been rather clearly shown in quite some papers is that consumers have a higher willingness to pay for self-made physical goods, right? So it has been, for example, shown that even if you have no customization, I mean, customization would be an obvious thing, right? So if you have no customization, you have very clear routes on how to design, say, furniture. You buy it from IKEA, you follow just certain steps, but after you have done that, you value that good, which you built yourself, higher than if you would just buy this good already done.
So that is the IKEA effect?
Come again?
Is that the IKEA effect?
Exactly, that's the IKEA effect. So the IKEA effect is that something you build yourself, you value that higher than buying exactly or having exactly the same good, but not building it yourself. So you basically value goods, physical goods, but also non-tangible consumer goods, like t-shirt designs, more if you have done that, even if you follow very clear instructions, right? So if there's no customization, nothing from your own basically is in there. You just put in effort. So that has been shown. It has been shown in economics and psychology, and that goes beyond just customization, right? So as I said, they have typically very clear instruction. You cannot customize anything from your own there. You just follow clear instructions and still evaluate higher. And it depends on successful completion. It's not so important for our paper. Anyway, what this paper now does is basically ask if people can self-build their own portfolios, which they can in real life. Is there, and how does such an IKEA effect affect financial decision-making? In particular, what drives this effect? And how does self-building a financial portfolio affect the trading after you have received new information? Right, so the question is, how do you, first of all, value the portfolio after you have built it, and how do you trade it afterwards? And why should we care? Well, first of all, IKEA effect has implications for the personal wealth of retail investors and trading decisions. That's basically the demand side, but also the management industry, right? So the supply side, if they know that people value it more than they should, potentially they can benefit from that. And I think as economists, more importantly, is the asset market outcome. So that might in part explain or lead to excess trading volumes or increased volatility, because you basically have built something and therefore you are less willing to sell it, or you want more money in something of that sort. Okay, so we argued that is something very important to look at and understand. Potentially one has to adjust as a market towards such externalities. Okay, so how do we do that? Obviously we do an experiment. I don't think I have to explain here why we do an experiment. And we're doing the following. So people have two different pre-specified target portfolios, right? So basically they have, or they exist in general, two target portfolios, and every participant is self-building one of those. So everybody is building one portfolio. I will explain in a second how they're building it. And we randomize which portfolio participants have to build. It's either the first or the second, but participants have to do tasks, which I will come also into a second, for both portfolios, right? So they see two portfolios. One of those they have built, and then they have to basically indicate how much they value this portfolio and how they will be trading this portfolio. Now, we randomize the ordering of the portfolios and the task, right? So they see first, for example, the first portfolio, which they have self-built, then the other portfolio, which they have not self-built, or the other way around. And also typically they start with valuation and then do the trading task, or the other way around. So everything is counterbalanced, and already there are no order effects at all. So again, everybody builds one portfolio, but values has to do tasks for both. Now, how do we do that bit? So the two target portfolios are exactly the same for both groups. And this way, any customization can be ruled out. So they follow very clear instructions, and there cannot be any customization. They cannot put anything of their own wishing into there. And as both groups, right? So the difference between the two groups is the one group builds the one portfolio, the other group builds the other portfolio, but both see both portfolios. So therefore, there are also no learning effects, because it might have been that self-billing in its more what means and standard deviations and so on mean, that might already be driving effect. In our design, this can be controlled for. And participants have the exactly same information set, right? So they know everything. The only difference between the two portfolios are the financial weights in what they differ. So I come to that in a second. So basically, how did portfolios look like? They consist of 5 real-life asset classes, in particular, developed market stocks, emerging market stocks, investment grade and high yield bonds, and alternative investments. So that's the 5 real-life asset classes. And then within each asset class, we have 3 sub-asset classes for development in US and Japanese stocks. And we use real-life historical monthly data from these asset classes because we wanted to make sure that all the data is realistic. It's not that it's an outlier or our results are weird because what we used as data is something unusual. So we used real-life data. And we then designed labels and logos for both portfolios so that participants can easily recognize and remember the portfolios. And as I said, both portfolios consist of the same asset classes. So the same asset classes and the same within asset classes. In particular, the weights in the within asset classes are also identical. The only difference between the two portfolios is that the one portfolio has more weights on, say, developed market stocks, while the other has more weight on alternative investments. So the two portfolios are the following. The one we call Silver Tree. This has this nice logo, and it has a monthly return of 0.67%. That's just what in real life it has, and a volatility of 2.46, and that would be considered typically a conservative allocation portfolio. And the other one we call Redstone, and it has a slightly higher monthly return, but therefore also higher volatility. That would be typically considered something like an aggressive allocation portfolio. So that's the two portfolios. They have to build one of those, but they have to make all the tasks for both of them. So how do they construct, self-build this portfolio? Basically, what they have to do, we put them step by step through all this process. So say for the first asset class, here they have this within asset class task, and then they are told what the target return and target risk value has to be. Then they have to find the one combination, and it's always only one combination, which fulfills exactly this property. Now, as we realized at some point that this is way too complicated, people will not be able to find the right spot right away at least. We fixed one of those weights. So we told them, for example, I think here, the combination of US and European stocks such that the return basically is identical to what we give them as a target. That would be identical to basically building up and furniture. You're told step by step what to do, and then you have basically to do that. That's what exactly they have to do here. Okay, so that's the building. That's how you basically build your portfolio. Now, we want to measure how they value this portfolio. To do that, we use the BDM, the Becker de Groot-Marschak auction. So what people have to do is they have to formulate a minimum selling price. And then a random price is drawn from a uniform distribution, which we call the market price. Now, if the market price is higher than your minimum selling price, you're basically selling it and you're as payoff getting this market price. But if the market price is lower than your selling price, you basically have not sold it, then you keep your portfolio for one more period, and your payoff will be determined by the random draw from the historical returns. So, for example, this is how it looks like for Redstone. We show them the distribution, that's real life distribution. We used 123 month, previous month. No, I think it's slightly less, but we use 123 as the nominal value, basically so that we don't get too easy numbers. They see the distribution, then they have to figure for themselves out what is their personal selling price. And again, if the selling price, so then we randomly draw a market price. If the market price is higher than the selling price, they sell. If it's lower, they get as payoff a random draw from this distribution. This ideally should be incentive countable and should be in particular such that it's your dominant strategy to tell the truth. So you should tell your true willingness to pay as the minimum selling price. Okay, so that's how we measure the valuation of the task. To measure trading behavior, we do the following. So we tell them you're now endowed with this portfolio. In particular, we tell them you have invested in this portfolio before, you're now holding this portfolio. And then we tell them, okay, and we use real life data again there. So we find real life data such that they either receive a strong negative response, meaning that the return has reduced by 4 or 5%, a weak negative signal, so the return has reduced by 1 or 2%, a weak positive or strong positive signal. And then for each of those 4 scenarios, participants can either sell the portfolio right away with the corresponding gain or loss, or they can keep it for one more month, one more period, and then they get as payoff the real life payoff of this asset or this portfolio 1 month later in this past month. So I show you that in a second. So what we did, we basically found month where there was indeed a increase of 2%. We told them, okay, it's in 20. We don't tell them the year, we don't tell them the month. In particular, we didn't want that people can basically Google how well in general the market looked like. So we told them you bought it basically 1 month earlier. Now you received a positive response. What are you going to do? Are you going to sell this or are you going to keep it? And if you keep it, you basically tell them what happened 1 month later. And then we also ask them what they believe this portfolio will be 1 month later. Okay. So that's the two tasks. Does IKEA effect? So basically the effect that you value something more just because you build it affect basically trading behavior, and in general, how does it do so? So we also measure a lot of beliefs. So we measure how people assess information. So we basically use mouse tracking to figure out whether they look more at the positive information more than negative and so on. Okay, so let's come to the results. Okay, I guess I was gone for a second.
Yeah, that's true.
Yeah. So did I explain this? Basically, let me start over this slide. So again, the only interesting thing here is that we have sufficient power to detect even small effect sizes. Okay. Okay, so let's come to the results. Now, one thing we wanted to make sure is that building this task, building this portfolio, it shouldn't be too easy, but it shouldn't also be annoying. So we basically asked people, how enjoyable was building this portfolio? 5 minutes. Yeah, thank you very much. How complex was building the portfolio? And how proud were you after having accomplished that? And what you see is that people found it rather enjoyable. It was okay, or it was even fun. It was rather complex. Some people said it was very complex. They had to put rather much or very much effort into it. And most people rather agreed with the statement that they felt proud after having accomplished building this portfolio. So again, the important thing here is that participants did not consider it trivial, but it was also not annoying. Then we asked them, how attached have you felt to what portfolio? But we just wanted to get a feel at it. And particularly, we wanted to see that our experiment basically works. And what we found, okay, so what do you see? Aspirants have to value both. We're asked this question for both. You basically can see the switches. That's the gray lines here. Red here is if you build your portfolio, basically, you're asked how attached are you feeling towards, say, Silvertree, and Silvertree is the one you have built, and the other portfolio is the one you have not built. And what you can see is there's a significant increase in attachment. So people before felt rather slightly attached, now they feel moderately attached. It's not too much attachment, but again, they don't have it in their hands. This is a non-tangible good, which they basically constructed on the internet, but still it has a significant increase. Now let's come to the evaluation task. Okay, so there's quite some information here, so let me quickly summarize. I have split it for both the portfolios. Here you see Silvertree, and here you see Redstone. Red dots is your valuation if it's your portfolio, so if you have built Silvertree or if you have built Redstone. And red dots are the other portfolio, so if you have not built Silvertree or if you have not built Redstone, then you see here the mean, here you see the box plot, and here you can see the distribution. So basically, every information we have about the data is presented here. And what you can very, very clearly see here is there is absolutely no difference. So there is really nothing wrong. There is no increase in mean, there's no change in distribution, look basically identical. So there's really, really no difference. So you do not value your portfolio at all higher if you have self-built it.
Have we lost Vladislav? I know, there you are.
And I'm back again. That's the last result, and then I'm through. Sorry for that. Anyway, so the most important thing from the training task is there's also absolutely no difference, neither for small losses, nor for big losses, nor for big gains, nor neither for small gains. Absolutely no difference. So basically, the selling and trading behavior is identical. So in conclusion, this paper is the first to study the effect of still building a portfolio on financial decision making. What we find is that there is a significant increase in the attachment towards that portfolio. However, this does not translate into financial assessment of the portfolio. It has also no effect on trading behavior. There are also no changes in beliefs. I didn't talk too much about that, but we also measured beliefs on almost everything. No changes in belief. Also, the information processing does not change at all. So we measured, as I said, mouse tracking, whether they look more at the positive or negative information. Absolutely no difference there. So apparently the IKEA effect, which has been shown rather stably across certain domains, does not translate into the financial products. And that might be because thinking about financial products might activate more rational thinking. And that potentially drives out the IKEA effect, which is a psychological effect. That is it. Thank you very much for listening. Very sorry for the internet connection, and I'm looking forward to any questions you might have.
Thank you so much, Vladislav. Is there any question? Well, if not, then thank you very much. And let's move on to the next talk by Wolfgang Luhan, University of Portsmouth. Floor is yours, Wolfgang.
Thank you. Let me share my screen if I can manage. Okay, you should be able to see my screen now. Okay, so thank you very much. Thank you for attending this session. The title, I'm not going to read the very long title, What You Want and What I Get, and I basically prefer the shorter title anyway, How to Get People Back from the Dark Side. What I'm going to attempt today is I will try to present two papers in one. One is published already, but what I'm presenting is a very important extension to that paper. So I'm going to briefly go through the design, which is very similar for both papers, and then present the old and the new results. So if there's any questions in between, please just ask, just unmute and ask me, because I might not see the chat. And then I'll try to make things clear from the beginning. By the way, forgot to mention my co-authors, Sascha Füllbrunn from Radboud University, Georgia Buckle also from Portsmouth, as myself. Okay, so what's the motivation? In principle, there's two results that we can look at when people make financial decisions for others. So the first one basically comes from a series of studies by Allen and co-authors from the beginning of the 90s to the 2000s, so theoretical and also empirical papers. And what they show basically is when you make financial decisions for others on financial markets, there is usually limited liability, which leads to higher risk levels on financial decisions, which might lead to or foster rational bubbles. So what we mean is on financial markets, usually individuals cannot invest themselves, but what they have to do is they go through a money manager, a stockbroker or whatever. These people are usually paid on a bonus scheme, which means when they make money with their investments, they get a share of the investment, but if they lose their clients' money, they're not participating in the losses. So the losses are purely their clients' losses. So that's the limited liability, that you're not liable for the losses. And of course, if you can imagine in such a situation, it's basically a gamble where you can only win because you get a part of the winnings, but you can't lose. Of course, you will increase your risk when you make these decisions for others. Very short, if you know the Allen and co-authors literature, it's a little more complicated, but that's the principle that we're going with here. On the other hand of that, there is a literature that says when you're making decisions for others, you actually have a feeling of responsibility, and that what's also called responsibility alleviation might lead you to be more cautious. Oops, sorry. So that more cautious might mean that you're taking, for example, in experimental studies, you take more effort when you're working for others than for yourself. You're more conservative, which means that you take lower risks when you are making decisions for others. So on the one hand, we have got a situation where we should find higher risks on financial markets. And on the other hand, there's a literature that says, no, you should actually be taking lower risks. So the whole situation now looks very much like it is the limited liability, so only that bonus scheme that leads to these higher risks that have actually been observed on financial markets. So we are asking now, is that really the case? So basically what we're asking is whether people are really evil in themselves, so it's just the money that makes them evil. We're now going to split that up to study this in 2 steps. Firstly, we say, what happens if I don't give you that bonus payment? So first we start by letting people make financial investments or risky investments for others without profiting at all. So you don't get anything, you just make a decision for somebody else. Theoretically, we could observe a risky shift or a cautious shift. That means that you're taking more risks in a risky shift than for yourself when making decisions for others, or fewer risks or a cautious shift when you make decisions for others. One reason for the cautious shift might be the responsibility. What's with the risky shift? Well, there's a long literature that I don't have time to go into, but you can say, for example, if you make a decision for somebody else and there's no money for yourself involved, you see this kind of like a hypothetical situation, you're indifferent here, and then you just gamble away for the fun of it. Okay, but in principle, we could see 2 things. You don't get any money, you could be either more risky or less risky. Now, let's move on to what we discussed in the financial markets. There is this limited liability. So in the second step, when we've established that without that bonus payment system, you're either more or less risky, then we'll see what the payment scheme does. So this limited liability might drive you, even if you've been more cautious beforehand, to take higher risks then. We're using a very well-known game, the Gnisi Potters investment game. Let me briefly go through that. So you get an endowment that we call E, and out of that endowment, you can invest anything from 0 to the full endowment X, and whatever you don't invest, you keep. So the investment now can be successful with a 1/3 probability. If it is successful, you get back your investment plus 2.5 times what you've invested as a return, but with a 2/3 chance the investment fails and you lose all your money. Now, the nice thing here is that we can directly use the amount of the investment as a measure for your risk. We're also going to compare that to other risk measures, by the way, but it's not just an investment, but it directly leads us to get us a risk measure. In this first experiment, we have 3 treatments. First, we let people play this game for themselves. So that's like the basic Gnisi Potters game. You invest for yourself, you lose your money, you gain something if you win. Our second treatment is for others. So you are investing now for a group of passive investors. So that's going to be 6 people. I'll come to that in a second. And you don't get anything yourself. So the decision maker is a pure money manager and gets nothing. You don't get any bonus, you get nothing for the investment, it's just for the other people. And as I said, the last step is going to be our limited liability treatment, where you again do the same thing. You invest for 6 other people, but you now get a share of their positive returns. And now it's important that we split this success up into you get the investment back plus the 2.5 times the return, because you're only getting a percentage of this return here. Okay, so that's basically our 3 treatments: invest for yourself, invest for others, get nothing, invest for others with a limited liability. We played that in Bochum at the Rubex lab. We used C3, of course, and as I said, We've got 6 people that you're investing for in the others and limited liability. Everybody got an endowment of €9. And in the limited liability, you get 5%, so a very, very small bonus of the returns if you're making a successful investment. Of course, everything is very complicated, so you have to work with 6 people, €9, a percentage of 33% of winning, 66 of losing, and so on and so forth. So we gave people a calculator. So on screen, you could basically enter, I want to invest this, that, or this. And then the calculator will tell you, this is the outcome if it's a success, this is the outcome if it's non-successful, and so on and so forth. By the way, you're making the same investment for all of your clients. So you basically make one investment, and that's the same for all the 6 people in your group. We played this game with 273 people, from basically students from all departments of the university in Bochum. Took more than half an hour, and the average payoff was €17. Okay, what's the results that we get for this first step? Firstly, we see a significant cautious shift. So in line what we said with responsibility, we find that when people invest for themselves, they roughly invest a little bit more than half of what they have, €4.55. When they now make the very same decision for others, they on average invest 3.9. It's a significant difference here. Okay, basically I'm just using these bar charts, but we used, of course, regressions, non-parametric tests. So when I say significant, all of this is significant in various ways. Okay, we split this up now a little bit and said, okay, where does this come from? Because there's a wide range of individual investments. And when we split our sample of money managers, when they make the decision for others into a higher risk group and a lower risk group, this is the 2 results that you see. What does high risk group and low risk group mean? Well, we define the median risk investment, and then we split our group of investors into people that for themselves in the first stage in the own investment invested more than that median or less than that median, so that are higher than average risk takers and lower than average risk takers. And what we see now is that the higher than average risk takers now have a very strong decrease of their risks for others, so a very strong cautious shift. On the other hand, the lower than average risk takers increase their risks for others, but only moderately so. So the overall effect is driven by people that are aware that they themselves are more than usual risk loving. So if they make investments for others, they know they should go down a little bit. And overall, this result is this effect is so strong that for the whole group, when we're not splitting up, we find a cautious shift. What we also see here that it seems to be people want to do what they think the others would want themselves. And we confirmed this also with a questionnaire that people actually stated what they think the others wanted and acted accordingly. I'm a bit short here because really what I want to talk about is, of course, what happens when we invest for others and get a bonus treatment. So overall, significantly with a cautious shift, you act for others, you take lower risks. Now I give you 5% of what the others get, and this is now the blue bar. You see the investments go up quite significantly. So what we find is that even a very, very small bonus, so for every euro that you invest for others, you only get 5% of their probable returns. This completely crowds out the social responsibility. And now if we again split this up into high and low risk people, there's no difference anymore. Everybody is making these very high investments. We also have got a very high number of full investments of our sample, so that people basically risk everything for others only to gain a small monetary effect. So the problem that we find here, or if you want to call it a problem, that we said, in principle, people are social. They want to take low risks. They want to do the right thing for others. But if we only give them a small amount of money, this completely goes away and they get very greedy and invest everything. on financial markets, there's now two ways to react to this. Firstly, you could say, well, I just, throw policies at them and I forbid this behavior. But of course, as a behavioral researcher, we're interested, can we just create a situation where people themselves don't want to act that selfish anymore? How can we get them back to the more social behavior that they showed before? So we use a couple of things that were found in the literature. Notably, we use in our new treatments information about the others and accountability. So the information about the others that we use this, basically, we found beforehand that people stated even they wanted to do what their clients wanted, as long as they don't get money for this. So when they get money for this, we said, well, let's give them a stronger hint. Especially there is literature that says if you tell people what their clients want, that shifts them towards their preferences. So what we simply did in our experiment is we showed them what the group of 6 people that they're investing for have done for themselves previously. So we tell them this is really what they want. The second thing that we're trying in our treatment is accountability. So there's again a literature that shows if people are held accountable for what they're doing, because in usual lab experiments and in ours as well, of course, everything is anonymous. Nobody has to defend what they did. We are now introducing accountability and said we hold you accountable for what you're doing, or better, even the group that you made the investment for will hold you accountable for it. There's several ways to do this, and we just wanted to see the strongest effect that we could get. So basically, we do everything that has been done in the literature in once. Firstly, our clients can rate the decision on a scale and say how satisfied they are. Secondly, clients can voice their concern. They can say, I liked it, I didn't like it, verbally. And thirdly, and this might be the strongest, actually we take the decision maker and one selected member of the group to a separate room, and they have to have a face-to-face chat with a moderator, so to avoid physical violence. And they have to say, this is what I've done. Okay. Keep in mind, this is a one-shot treatment, so it's really just the psychological effect of when I, as the decision maker, make this decision for others, I know that this will be coming afterwards. It's not a learning effect. It's not that they revise their decision afterwards. It's a one-shot, but when you make the decision, I tell you, you will have to defend yourself. So these new treatments were implemented now at the Radboud University in Nijmegen. 168 observations for our treatments. And let me briefly show you what it looked like. So in the middle here, you see the calculator where basically can enter any investment that you liked. Okay, then the calculator will tell you what the payoff for the others will be. In case of a failure, and here in case of a success. And you can type in as many numbers as you want and then see the outcomes and then click on one and say, this is what you want to do. In the treatment with information, you see here all of the preferences of your group members. And in the treatment with the accountability, you still see this. And you also see here the rating of the group members, and here the verbal feedback that you will be getting. Okay. And also we tell people up front that yes, after the decision, you will have to go to another room and discuss it with your group members. And they might not be very happy with what you've done, but that's up to you. So let's see what's happened. We here have the original result from our old treatments where there's no information about what others want and no accountability. So in green, we'll add now the information treatment. So you see basically for themselves, people act the same as before. There's no significant difference. For others, we've got a very slight increase, but it's also not significant. What we see, however, is that we have a significant decrease in the limited liability. So as we had hoped, when I tell you what the others wanted, you will now decrease your investment, even if you're getting a bonus. You still see it's not perfect. So it is going down a little bit, but it's still way more than if I'm not paying you for this. So this is not perfectly working to get you down to actually this is what you do without any monetary incentive. So let's add now the accountability. So the orange bars, again, no significant difference in the standard. So these people are not different than the others. What we see now is a spike in others. So if you not only know what the others want, but if you're being held accountable, for some reason now you think you have to invest more in others, you're not getting money here. Okay, so this is a significant spike here. More importantly, for our financial market situation where you get a bonus payment, again, we see a significant decrease, and this is now significantly stronger than in the information treatment only. But what we also see is that it's still not getting you down to the levels when you're not getting money. So this now works much better, but it's not perfect. So even if we throw all the things of accountability and information at you that we can think of and that have been shown in the literature to work, all of these work, but we're still not down here to the level that you would do without any monetary incentive. Okay, so this is basically all the results that I'm going to show today. And as I said, we of course ran more elaborate analysis than a few bar charts, but I don't think there's any reason to go through a slide and slide of regression results. So let me briefly conclude. We started out and said, if I don't give you any money, people are actually responsible. They invest less than for themselves because they want to be responsible for the others, add a small amount of money to that decision, and they completely throw away the social preferences and get a risky shift. Okay, and if we do that, also your own risk attitude is no longer relevant for your decision. Everybody invests very high. Now, adding information about what the others want reduces that a little bit, not very much though. Accountability is more effective, but we're still not getting down to the levels of the social preferences without monetary incentives that we had before. So it is working quite well, but you have to do quite a lot, and it's still not down to the original social preferences levels. Okay, 19 minutes, I think I'm on time. I'm done with my presentation. I'm happy to answer any questions you might have.
Thank you very much, Wolfgang. Are there any questions? It's open for questions. So let me ask you a question.
Yeah.
You have in the original data, you have a limited liability treatment, and there you say, okay, if you look at risk lovers and risk avoiders separately, and then you get a different result. Do you have a similar result also with the new data and also with the limited liability treatment?
No, with the so that's the basic comparison that you mean, that
Yeah.
the risk lovers go down and the risk avoiders go up, but only slightly so. That picture basically stays the same for all other treatments in the others without the limited liability. So for the limited liability, we find no effect for these comparisons. So as soon as you give people a bonus payment, there's no difference between those people. And again, that stays the same in the new treatments as well. So even if you tell them what the others want, even if you add accountability in the limited liability, we don't find any differences between those two groups of high and low risk preference investors themselves.
And then perhaps another question. So you have the meeting, well, the satisfaction basically, and you have the so-called risk profiling at the beginning. Would you have, have you analyzed these effects separately on the decision-making of the fund manager?
Yeah, we haven't done that yet because, of course, that's going to be one of the next steps. Right now, we just wanted to, so we basically, you could do this stepwise and add one step and another, like the meeting and the information and so on. Right now for the accountability, so we have the information, we have the accountability, but for the accountability, we do everything at once. To see how it works. It actually worked better than we expected. So the next steps will be to do this separately, but we haven't done that yet now.
There's still time for another question if someone would like to ask. Well, in that case, I thank you very much, Wolfgang.
Thank you.
Okay, let me share my screen with you. And I hope you all can see my screen. Can I get the feedback here with a thumb up? Wolfgang, do you see my screen?
Yes, we can see.
Thank you. Okay, so thank you very much for your interest in coming to the session. This experiment is on communication. It's actually on free-form communication. It's a chat that we add to the Chan Williams framework, and then present here. There's as you see, there's preliminary results, and that just says that there's no paper yet, and perhaps I still have to do a little more in-depth analysis. So, but of course, yeah, this is why we have meetings, and I take advantage of this to force myself to work on these things. So this is a standard outline. Yeah, I give you an introduction, and then I introduce you to the design and the research question, basically, or how I motivate the research question, and then preliminary experimental results and preliminary conclusions. So, you know, this is a very extensive literature and experimental literature. There are, well, I know that there are two extensive literature reviews. One is with Jordi Brands, and the other is with Andreas Blume, and they have very little overlap. So, but you see there are really many papers cited in these surveys, and the one that Jordi Brands and others consider is basically they're focusing more on a cheap talk and perhaps also promises thing. Yeah, so and then there is this is more maybe the public stuff, and then we have the others. Yeah, so they consider more coordination gains. Maybe one important result here is that here we have the free-form communication helps to increase the efficiency in social dilemmas and also in coordination gains. And we have that limited communication. So if you say they can only, subjects can only use pre-fabricated sentences and send them or whatever, yeah, that could have even a better effect in some settings because it avoids coordination failure. So, and in that case, if you have simultaneous sending, yeah, if you have two players and they have simultaneous sending in both directions, then there might be miscommunication, and it obviously leads to some problems. Therefore, some papers argue that one-way communication, where you basically have a leader who is deciding, hey, move A, yeah, then both can easily then also agree on moving A. Instead of having one saying A and the other saying B, then nobody knows what you can do. Okay, there's also an extensive finance literature because obviously it makes a lot of sense to talk about your investments, and people do that on internet forum, and so there are also many analysts posting then their review of certain companies. And these are the professional and also private investors who do that. And there are some results, and I only name here two, but there is more in the literature to see. So investor opinion, yeah, in social media and reader responses. So this is basically a limited access page, yeah, where you have to pay basically for entrant, and there's one who posts a comment on a company and an analysis, and then there are some readers of those, and they can respond to it. And they find that in this paper and financial studies that such investor opinion, if it is favorable or negative, so if it is a short story or it's a long story, this actually predicts then future stock returns. You have also, but this is a working paper from 1998, so someone has already looked at stock discussion forums where you have the message posting volume, if you look at rather than the content, because there are of course bulls and bears selling their story, and much of it is perhaps without little insight what is being posted there. But they find here, Vysoky reports that message posting volume overnight is able to predict then the trading volume and the returns. Maybe that makes sense because yeah, if there's more messages, then there's obviously also more interest in a certain stock, and that is basically and then creating. When do you have interest? Well, if you're considering an investment. Or okay, so in this paper, I look at the Smith-Williams experimental asset market and add then chat groups, and yeah, well, in finance, this is obviously a low-hanging fruit, and in finance, if nobody has invested in something, there is frequently, of course, a reason to it. And well, so here are the very preliminary results on the effect of communication. What I'm of course interested in is setting, but I'm going to motivate it in a little bit more detail on the coming slides, that mispricing seems unaffected. And then we have also that transaction volume is affected, but it is different from what Vysoky says, but I'm coming to that later. So here, a baseline Smith-Williams design. Yeah, I don't have to go through all this, you all know it. I guess you have a market size of 9, there's a multi-period lift asset is 1, and it goes over 15 periods, and dividends can be drawn from 60. 8 or 0, so really standard expected dividend 24. And we have that the market participants are participating in a continuous double auction and therefore can buy and sell in real time, well, not a post, and then they can accept the outstanding. And well, different from what Smith-Williams do in their design. All the 9 traders in the room have 2 asset units and the initial cash balance. So this is their second endowment type that we're implementing overall, because it's more complicated perhaps if you have different types, and we just want to see the effect of chatting, and so. Yeah, we don't need basically a reason, not even for trading. Anyway, yeah, I don't have to tell you this, but of course you have the declining fundamental value, and then what you frequently observe is kind of bubbling. This is from Smith, Jennings, and Williams, and it's of course an exaggeration, and you rarely have such a pattern, but it happens from time to time. We have also some of those. So now we have a second treatment. So the baseline treatment is basically Smith, Jennings, and Williams. And the chat treatment is basically the same. It's the same market setting, but we do it a little bit different than you perhaps would have anticipated. We have 3 chat groups of 3. And so they are sitting then together and discussing among the 3. Why do we do that? Well, because we had a pilot. And in the pilot, we had everybody communicating with another, but there was hardly any messages sent. And if there was nothing basically of content what was posted there, and therefore the idea was we go one step further and we give them incentives. So how do we give incentives? So chat groups were incentivized in the instruction as follows. So they would get a bonus pay. So there are 3 chat groups, a bonus pay according to their performance. Yeah, so as a group. And so and then we have that the sum of the earnings of the 3 group members of the chat group is the highest among the 3 chat groups. Then you get a €5 bonus pay. If it is second, if you're second ranked with your group, everybody, every member of that group gets €3. And the worst group, well, the least performer, those where the sum of the earnings of the 3 members is lowest, they have no bonus. Okay, I think this is quite simple, but if you don't really understand, then please let me know. Yeah, so this is an incentive structure, so that we make them basically incentivize them to use the chat for their communication and basically to formulate a strategy, a joint strategy, how to beat the others in the market. And here's a note, the baseline and the chat treatments, they differ here by more than one variation. You have chat groups, and you have an incentive, okay? Whereas in the baseline, they cannot chat with another, and you have no incentives. Okay, so here is a screen. Okay, and there are 2 stages basically. One is before the market opens. There's a chat box, and each of the partners is identified by a color. So one has a white frame here, the other has a green frame and a blue frame. And then this is Mr. or Mrs. White, green or blue. Okay, so and they are identified also in the chat box so that you know from where the comment comes. And in the baseline, you have a similar first stage, where you have where you just see the screen. You see here the results also after each period of the prices, the average prices. Over the time, and you see already this is in Spanish because the experiment took place in Spain, and this is in the first stage. The second stage, the trading stage, this trading screen, and we have here the chat box, so they can chat before and during the market session. You have here transaction prices and here a price chart. As soon as prices are created, they are reported in the transaction price list, and you have also that they are reported here in the chart. Okay, and here you have the trading mask where you have here buy offers, sell offers, and here offer submission. You can cancel your offers if you like, but this is quite standard. Okay. Okay, here's my motivation of and the research question. Frequently you have that confusion is cited for mispricing in experimental asset markets. And of course, if you can exchange information, if you are a confused subject, that is the idea. If you're confused, then you can ask questions to your fellows in your group, and you can discuss with another how to address the tasks that you're facing. And so this is basically helping, hopefully helping to eliminate and also mispricing. Why is it? To mitigate, so the research question is, does communication help to amend mispricing? And I'll give you one example how I was thinking the subject would address it and how they would come up. And how basically the mispricing would be mitigated. A winning strategy would be, if you as a group coincide that you buy below the fundamental and sell above the fundamental. You cannot do that if you're alone, but as three subjects, you have the financial power, basically, to play this, to buy always below the fundamental, sell above the fundamental, and then you would be the winning group. And €5 is substantial. As you see, there's 13 is your expected gain from the asset market, from the asset that you're holding, and from the cash that you have. And then on top of that, 5 is, as you see, it's more than a third of the potential gain that you can get. And so therefore, I think it makes a lot of sense to do that, but I would like to hear your opinions on it. Anyway, here is the experimental data. Okay, we had 13 cohorts of 9 subjects. We have the 2 treatments, the check treatment, and we have the baseline treatment. There is a female, 52% of the subjects were female. Then we have a CRT score elicited with a Frederick. That's 3 questions of 0.65, which is low. But actually, this is not a bad thing. If it is low, then you can argue that the benefits to communicating with someone who knows better within your group, are actually increasing. And we have an age of 24.8, which is a little bit biased because in Castellón, where we had this experiment, it is frequently that you have people over age of 50 and 60 participating in the experiment, but most of the subjects are student subjects between 20 and 25. And then we have an average pay, and we use standard software. Okay, here's a preliminary results. You see this is a baseline treatment. Here you see we have a takeoff here of a bubble and then a kind of crash. And you don't have it in the chat that way. But there's, well, I don't know if you see any difference here. It turns out, well, if we look at the statistical measure, and I'm going to do that on the next slide, but you can also see that here perhaps from the chart. And you see the thick line. The thick line is the average price across the 13 cohorts. And if you look at the average, they look pretty much alike. But here's then the statistical analysis. We do relative deviation and relative absolute deviation of Stöckel et al. And here we find, well, with a Mann-Whitney test, we cannot find any difference. Well, however, here is one result. And I mean, what I still can do here is look at other measures, but frankly, if you see this, it looks very similar, so I'm not so sure if I get anything out of it. So here is a second result on transactions. Communication impacts the number of transactions in this experiment, and you see, if you chat, then you have another thing to do. So there's also a paper in Econometrica with a Lee plot, and it's there. And they find also if they give a second task to people, then they trade less in the other market, and then the bubble is perhaps smaller or whatever. So you see here, you have fewer transactions per period. These are transactions per period on average. And you see, this is significantly different, although it's not highly significant. If we had a directed hypothesis, we could say, this is highly significant. However, also, if we look only at the chat treatment and look at the correlation between the number of transactions and the message volume, we find there a highly significant, meaning below 5%. I think it's p-value is 2.6. And this is of course also two-tailed. So this is a regression, OLS regression over the 13 observations that we have. Okay, so what we did do, or what I did do, was looking basically at what they actually do. If they discuss the fundamental, and it turns out they don't talk about fundamental, but rather how to manipulate perhaps others in order to make them to buy at a very high price. So that is that they discuss, you buy from me at a very high price, and I buy it later back from you. And later, when others pick up this high price, then we are going to dump our shares. And then I did a keyword search, that is buy, sell, invest, and all these put in, and then I have basically a number that I can attach to these keywords when they pop up. It turns out that it somehow correlates with a share of females. So female communicate a little bit more, and the messages are perhaps a little bit longer. So that is why we have here a little bit more hits on the keywords. And of course, this is nothing new. The CRT groups with a higher CRT, they outperform those with a lower CRT. And here are my preliminary conclusions. We have free-form chat, and apparently it has no impact on the performance or mispricing in the Smith-Williams experimental asset market. Of course, it can be that if we look at a different subject pool, I mean, I'm a little bit frustrated that people talk so much about the weather and about everything. If you give them a flat box, they don't talk about their tasks they are in. So this actually can be influenced by the subject pool that we're looking at. In Spain, people like more to talk about football than about investment decisions. And so if you go perhaps to China, then you have a different response. It could be, and this is my last point, that if we allow only limited message communication, for instance, that we have prepared messages with a buy or sell recommendation at a certain price for the group, for the chat group, it could actually have an effect, and perhaps that is a way to go. If we have still time for a question, then of course I'm willing to take questions, but otherwise you can also send me.
We need to finish because we need to start the next session. So maybe you write your emails if someone wants to ask a question, because I can give you 1 minute and then
Sure.
you need to prepare the next one.
Tibor, thank you very much. I'll send you some comments. I wrote them down. So.
Thank you.
My comments are in the chat because you have a chat.
Okay, so
chat
I have to copy it.
Use my comment in the chat.
I don't. Okay, so let me stop sharing here. Okay, in the chat. Okay, I will check the chat, and I thank you very much. So I'm closing now the session. Well, enjoy your day, and we'll see again later this day, today, I guess. Goodbye.